Oil has crossed $100 a barrel again, but the biggest impact may not appear at the gas station. It will appear inside airline tickets, grocery bills, delivery fees, factory costs, interest rates, and corporate profits. A barrel of crude oil is not simply turned into fuel. It sits underneath the entire global economy. When its price rises, thousands of companies are forced to decide who will absorb the cost, who will pass it to customers, and who can quietly turn the crisis into higher profits. Brent crude settled above $100 a barrel on July 23 after attacks on oil tankers and severe disruption around two of the world's most important shipping routes. Trade through the Strait of Hormuz had already slowed dramatically, while attacks in the Red Sea created new risks for vessels using the Bab al-Mandab Strait. Even when oil itself remains available, the danger of transporting it can increase insurance premiums, shipping times, and fuel prices. That means the world is not only paying for oil, it is paying for uncertainty. The first businesses to feel the impact are airlines. Fuel is one of their largest operating expenses, and unlike a software subscription or office rental, the cost can change every day. United Airlines recently warned that its fuel expenses in 2026 could be almost $6 billion higher than the company expected at the beginning of the year. An airline cannot simply stop buying fuel. It can hedge some of its exposure through financial contracts, reduce less profitable routes, use newer aircraft, or increase ticket prices. But every solution has limits. Fuel hedges eventually expire. New aircraft take years to arrive. Cutting routes reduces revenue. Raising fares may cause passengers to cancel trips. This creates a brutal business problem. If one airline raises prices while competitors keep them low, it loses customers. If every airline keeps prices low, the entire industry can lose money. Companies are therefore forced to watch one another closely, increasing fares gradually while blaming the change on demand, capacity, or operating conditions rather than displaying a visible fuel surcharge. The passenger may never see the oil price written on the ticket. The passenger still pays for it. Shipping companies face a similar problem. Container ships, cargo aircraft, delivery trucks, and warehouse networks all consume fuel. When energy prices rise, large logistics companies often introduce fuel surcharges. These charges allow them to transfer part of the cost directly to customers without permanently changing their advertised base rates. That distinction matters. A company can promote a low delivery price while adding a variable surcharge later. For businesses shipping thousands of products, even a small adjustment per package can become a major expense. Retailers then face their own decision. They can accept lower profit margins, pressure suppliers to reduce prices, redesign packaging, slow deliveries, or charge consumers more. The largest retailers have negotiating power. A global supermarket chain may force food producers and transport companies to absorb part of the increase. A small independent store usually cannot. This is why energy shocks often make powerful companies even more powerful. Large corporations can purchase fuel in bulk, sign long-term contracts, spread costs across multiple countries, and negotiate aggressively with suppliers. Smaller businesses buy at market prices and have fewer ways to protect themselves. When costs rise rapidly, the company with more cash and scale can survive longer. Oil also reaches the grocery aisle through agriculture. Modern food production depends heavily on diesel-powered machinery, trucks, refrigeration, fertilizers, plastics, and processing plants. A farmer uses fuel to operate equipment. A truck transports the harvest. A refrigerated warehouse keeps it fresh. Another vehicle delivers it to a distribution center, and another carries it to the store. Each stage adds a small energy cost. Together, they can materially raise the final price. Perishable products are especially exposed because they require fast transportation and constant refrigeration. Produce, dairy, meat, and frozen food cannot simply sit in a warehouse while a company waits for fuel prices to fall. Petroleum is also used to produce plastics and synthetic materials. That connects oil prices to packaging, clothing, shoes, toys, school supplies, electronics, and countless everyday products. A consumer may never buy gasoline yet still experience higher oil prices through a plastic bottle, a polyester shirt, or a package delivered to the front door. The impact becomes more dangerous when companies begin raising prices in anticipation of future costs. Suppose a manufacturer expects oil to remain expensive for 6 months. It may increase prices today to protect future margins. Its suppliers may do the same. Workers may demand higher wages because transportation and food are becoming more expensive. Landlords may increase rents to cover maintenance and utility costs. The original oil shock begins spreading through the economy. This is how an energy crisis can become an inflation problem. Central banks cannot produce more oil or reopen shipping routes. Their main tool is interest rates. If higher energy prices push inflation upward, central banks may delay rate cuts or even consider raising rates. Higher interest rates then increase the cost of mortgages, corporate loans, credit cards, and business investment. A disruption in one shipping strait can therefore affect the price of borrowing money thousands of kilometers away. This is the hidden multiplier behind $100 oil. The direct fuel cost is only the beginning. The greater threat is that expensive energy keeps inflation high, forcing interest rates to remain elevated and slowing the wider economy. Not every company loses. Energy producers can benefit dramatically. Total Energies recently reported its strongest quarterly profit in almost 3 years. Its second quarter earnings rose 67% to $6 billion as higher oil prices and stronger refining margins increased income. The company's refining and chemicals earnings rose more than fourfold. This illustrates an important point. The price of crude oil is only one part of the story. When refineries are damaged, restricted, or unable to meet demand, the price of diesel, gasoline, and jet fuel can rise faster than crude itself. A company that owns oil production, refineries, trading operations, and distribution networks can profit at several stages of the supply chain. It can earn more from extracting oil, processing it, and selling the finished fuel. This is why integrated energy companies can become some of the clearest winners during supply disruptions. But even oil producers must be careful. High prices encourage customers to reduce consumption, governments to intervene, competitors to increase production, and investors to fund alternatives. Reuters polling suggests the oil market could face a deficit in 2026 but return to a substantial surplus in 2027 if Gulf production recovers, American output remains strong, and Chinese demand weakens. That creates a difficult strategic choice. Energy companies could use today's higher profits to build new production. But large oil projects take years and billions of dollars to complete. By the time the new supply reaches the market, prices may have fallen. Companies that invest aggressively at the top of the cycle can be left with expensive projects producing into a weaker market. The most disciplined companies may instead return cash to shareholders, reduce debt, or invest only in projects that remain profitable at much lower oil prices. Total Energies maintained a $1.5 billion share buyback program even as prices increased. That decision signals that management values financial flexibility rather than assuming today's price will last forever. The companies most exposed to $100 oil are those caught between rising costs and price-sensitive customers. Airlines cannot stop flying. Trucking firms cannot stop buying diesel. Food producers cannot stop transporting goods. Manufacturers cannot instantly replace petroleum-based materials. Yet their customers may resist higher prices. The businesses best positioned are those with strong brands, long-term supply agreements, low debt, efficient operations, and enough market power to pass costs forward. This is why the same oil shock can destroy one company's margins while expanding another company's profits. For consumers, the process is difficult to see because it does not happen all at once. Gasoline becomes more expensive first. Then flights rise. Delivery surcharges appear. Food prices increase. Retail discounts become smaller. Central banks delay lower interest rates. Companies freeze hiring or reduce investment. By the time the full effect becomes visible, oil may already have fallen back below $100. But lower oil prices do not immediately reverse the damage. Businesses may have signed expensive contracts, purchased costly inventory, or raised wages. Airlines may have reduced routes. Central banks may still be worried about inflation. Consumers may have already changed their spending. An oil shock can disappear from financial headlines while remaining inside the economy for months. That is why $100 oil matters far beyond energy markets. It is not simply a higher price for one commodity. It is a global tax collected through transportation, manufacturing, food, travel, and finance. Some companies will pass that tax to customers. Others will absorb it through lower profits. A small group will use the disruption to gain market share or generate extraordinary earnings. The price displayed on an oil market screen may say $100. The final bill paid by the global economy could be much larger.